Finforall by Jupiter. My name is Dipansha Dhingra and today we are going to talk about hidden costs of mutual funds. Do you guys remember how some time ago people started noticing a cute tax on their airline tickets? I'm sure many of us, including me, were quite flattered. Yeah, it stands for Common Use Terminal Equipment Tax, but whatever. The point is, we often pay hidden costs with most things. Sometimes it's a rather appealing tax when you book your flight, and sometimes it's not so appealing tax or penalties on your mutual funds. There are many charges we unknowingly pay when we invest. Although, legally speaking, none of these costs are hidden from us, we generally don't understand the financial jargon all that well. Mutual funds are managed by asset management companies that employ fund managers to handle each scheme. Under these fund managers is a team of market experts and financial analysts who all need to be paid. Plus, working towards overcoming market risk can be a difficult task, which is why a cocktail of charges are levied on your investments. So today we'll be talking about these charges and how you can make better investment decisions with a scoop of knowledge and a pinch of basic mathematics. Let's start with a common penalty charge that might cost you a few $100. The SIP penalty. That is, if you miss an installment of your SIP due to insufficient balance, you can be charged between 250 to 750 rupees. I know how it sounds. Paying a penalty when you're already kind of broke, kind of ruthless, no? Enter Jupiter, the first in the industry to introduce the no penalty SIP. If you accidentally miss a SIP, we just skip it. Zero charges for being late. We promise. Now, getting into charges not even Jupiter can help you with. Expense ratio. This is the ultimate fee on any mutual fund. Think of this as the fees for the operating cost of managing a mutual fund scheme. Right from sales and marketing, advertising expenses, administrative expenses to transaction costs. Investment management fees, registrar fees, custodian fees, audit fees as a percentage of the fund's daily net assets. This can range from 1.05% to 2.25%. Why is expense ratio important? Because the lower your expense ratio, the higher your NAV would be. And of course, you will make more returns at the end of your investment. There are many components under expense ratio. Management fees. Management fees are collected from investors to pay the fund managers for the service they provide to manage the scheme. These fees are unavoidable and for obvious reasons. Again, these fees are variable and depend on the company. Maintenance expenses. Generally, stuff like maintaining your records, customer support, etc. comes under these expenses. Entry load. This is the fee charged when you just join a fund. This has now been abolished by SEBI for calculation of expense ratio. So one less thing to worry about. Exit load. An exit load is charged by a fund house when you redeem the units of a mutual fund. Exit loads are not fixed and can vary from scheme to scheme. Generally, exit loads range from 0.25% to 4% based on the kind of scheme in which you invest. This fee is determined by the fund house, mainly to ensure that investors remain invested in the scheme for at least the lock-in period. Remember, exit load is charged on your redemption amount, not capital gains. So even if you suffer a loss, withdrawing before the lock-in period is over will incur an exit load. But the good part is that exit load can be completely avoided if the investment remains untouched through its lock-in period. Commission and brokerage fee. Mutual funds come in two plans, regular and direct. In case of a regular plan, the AMC hires a broker to buy or sell shares of a portfolio asset. In this case, brokerage fee is charged. In a direct plan, these transactions take place automatically and thus brokerage is out of the picture. For example, when you invest through Jupiter in mutual funds, there is no commission, 12B1 fee. These fees are collected by asset management companies for the printing, mailing and marketing expenses incurred by them. Some other fees that may be charged are account fees. Account fees are sometimes charged by asset management companies if you fail to meet the minimum balance requirement. These fees are subtracted from your investment portfolio. Switch fee. A number of mutual fund schemes allow investors to switch their investments from one scheme to another by charging a switch fee. Expenses and charges on mutual funds for most part are unavoidable. But learning the semantics can help us understand what we are getting into and what might the end returns be. There's a reason they have the disclaimer. Mutual fund investments are subject to market risk. Read all scheme-related documents carefully before investing. So read up before you invest and choose funds that align with your future goals. Thank you for staying tuned. For more on finance and everything beyond, follow Finforall by Jupiter on YouTube, Instagram and LinkedIn. Don't forget to leave a like and share your views in the comments below.